Steve Blumenthal, you say there's a default wave headed for high-yield bonds and investors should steer clear of the JNK and other high-yield ETFs. So with rates low and the economy growing, why do you think there's going to be so much carnage in the high-yield space?
Well, let's take a look at the situation. We've had zero interest rates for 6-7 years now. And if you're an investor, where do you go? You race into high-yield funds, unsuspectingly. So the high-yield universe has grown from a $1 trillion market to $2 trillion in 5 years, additional $1 trillion. So if you are a business and you're looking for funding, let's just say funding was very easy to get. Not only was it easy to get, it was so easy to get that you could dictate the terms, so that the quality of the bonds that are issued are the worst, at the high end of the worst quality, meaning me as an investor, I get very little protection when the economy turns. And the economy, at some point, we've had 1 or 2 recessions every decade. I don't think that that's going to change. So at the timing of the next recession, whenever that is going to be, a lot of companies are going to default.
And you say that investors may want to rush to something like the BIL, which is an ETF, which is 1 to 3 month treasuries. Why is this a good place to run for safety?
Well, the Fed is, don't fight the Fed is a very important concept to get. They've been involved with every major turning point that we've had in markets. So think about that for right now. I would participate in an ETF like HYG, but I'd also participate with a mindset to protect. And if you think down the road of the forward opportunity that's coming, I think it's going to be an opportunity of a lifetime.
What about the idea of shorting some of these high yield, these junk ETFs, and profit from this wave of defaults, which is going to hit them just like it did in the winter when all the energy issues really brought it down?
Right. So not a bad idea, but you've got to get the timing very right. And there are some ideas around how to look and have a plan that gets you in and gets you out. So it's kind of participate but protect. The problem with shorting is right now, even though rates are just 6% yields on high yield bonds, you're paying that away when you short. So that carry is working against you the longer the trade in high yield continues to at least stay the same in price or move higher. So you've got to get the timing right.
It all comes down to timing in this market, and if you think that there's going to be some problems and you can make money shorting it, when do you short it?
Okay, so we have this fundamental view that you've got nearly $800 billion of the $2 billion is going to mature starting within the next 3 years, so next year through this cycle. A significant number of companies that got financed. So if there's a recession during that timing, they're not going to get funded, and then you start running into these bankruptcies. So what's the timing? Well, high yield trends very predictably, and when you look at price momentum, it tells you a lot about supply and demand behavior. So if you just put a simple, let's say 21-day moving average line on something like HYG, and when it drops below that smooth trend line, that may be a good time to short. Now, if it moves back up above it, cover your short and participate on the long side.
All right, well, thanks a lot, Steve.
Thank you very much.
And thank you for watching The Street.